Welcome back to my channel where we are going to be financially smart together. In this video, I'm going to be going over what makes up the premium of an option, which is important because that directly impacts your return on a trade. Option premium is made of intrinsic value and extrinsic value. Intrinsic value is the real tangible value that you can actually calculate, while extrinsic value is the future unknown variables of a contract. For a put option, the intrinsic value is the strike price minus the stock price. For a call option, the intrinsic value is the stock price minus the strike price. An option is considered at the money when the strike price equals the current market price of the stock. A call option is out of the money if this stock price is below the strike price, and a call option is in the money if the stock price is above the strike price. A put option is in the money if the stock price is below the strike price, and a put option is out of the money if the stock price is above the strike price. In both situations, when the option is at the money or out of the money, the intrinsic value is zero, which at that point, the option premium is all extrinsic value. So what makes up the extrinsic value? It's mainly the time value of the option and the volatility of the underlying stock. An extrinsic value will go to zero at the time of expiration. Let's take a look at the profit and loss graph. The purple line over here is the value of the option before expiration. And the green line over here is the value of the option on expiration date. And the distance in between them is the extrinsic value. So you can see here where the option is at the money, the extrinsic value is the greatest. And as the option goes out of the money over here, the distance between the line gets smaller and smaller, meaning the extrinsic value is also getting smaller. And as you move further into the money over here, the distance between the line gets smaller as well. The option premium is made up of four major option Greeks: Vega, Theta, Delta, and Gamma. Vega calculates how much the option price will move for a 1% move in implied volatility, meaning future speculated volatility. So if Vega is 0.2 and implied volatility changes from 30% to 35%, then the option premium will increase by $1, not taking into consideration the other Greeks. The more volatile a stock is, the higher the stock option premium will be, and volatility changes every single day. And you generally want to sell when implied volatility is high and buy when implied volatility is low. If you buy an option when implied volatility is very high, then there's a thing called implied volatility crush, where the implied volatility will fall dramatically back to its normal ranges. And in that case, you might lose a lot of money because the option premium will fall with the volatility. Volatility tends to increase leading up to a big event such as earnings, or if something big happened in the news. So before you make that trade, just check what the implied volatility of the option is, because implied volatility makes a big impact on what the option premium pricing is going to be. An easy way to remember this is an option with high implied volatility is expensive, and an option with low implied volatility is cheap. And in business, you want to sell when something is expensive, and you want to buy when something is cheap. If we assume that stock prices stay the same, then a short-term option loses value a lot faster than a long-term option because of time decay. The rate of decay is the square root of the time remaining. So a 3-month option will lose time value twice as fast as a 9-month option. And time value decay accelerates dramatically around 30 days left to expiration. Within that 30-day to expiration, a 5-day option contract will decay way faster than a 25-day option contract. Although on the face value, you might think a 9-month contract should be double the value of a 3-month contract, it's not true because of other factors that goes into the pricing of an option. Delta is how much the option price will change with a $1 increase in the stock price. So if delta is 0.5 and an option stock changes from $100 to $102, then the option price will increase by $1. At the money option deltas will be 0.5. In the money option deltas will be more than 0.5. Out of the money option deltas will be less than 0.5. You can also see that call options have a positive delta and put options have a negative delta. A delta of 1 is more sensitive to price changes than a 0.2 delta. Meaning options that are in the money are more sensitive to price changes than options that are at the money, which are more sensitive to price changes than options that are out of the money. So a call option that is further in the money will better imitate what happens when you buy a stock. And a put option that is further in the money will better imitate what happens when you short our stock. That is, if we don't take any interest fees into consideration. Gamma calculates how much a delta changes with a $1 increase in stock price. So if you have a gamma of 0.01 and delta of 0.5, when a stock price increases by $2, delta will become 0.52. Gamma is highest at the money and increases when the option goes to expiration. Gamma is directly related to delta, and when delta moves, gamma moves. You can think of delta as speed and gamma as acceleration. In conclusion, there's 4 major factors that goes into the pricing of an option that you might want to write down, or you can take a screenshot. The price of the underlying stock, strike price of the option, time value of the option, and volatility of the underlying stock. Therefore, the option premium pricing is a lot more complicated than the stock prices. And if you were to buy a call option to bet on the stock to go up, you might even lose money even if the stock price moves up, but not fast enough, because the implied volatility can fall or the time value decay eats away too much at your option premium. So in other words, you can buy an option and the stock moves in the right direction, but you can lose money if you don't know exactly what you're doing. One way people decrease the effect of volatility and time value is with spreads. And in the next video, I'll be using these concepts to compare a long-term option and a short-term option, and that will help you determine which expiration date to trade on. And put any questions you have in the comment section below. And don't forget to subscribe and hit the notification bell so you won't miss out on future lessons like this.